Good afternoon, everybody. This is Beatrie Gouws speaking from SAIT. Very welcome to all of you to the June 2020 Tax Practice on the Move session. We look forward to this particular session. First off, just some housekeeping issues. We are pre-recording this session so that it will be easier for you to download it and listen to it in the comfort of your home. Alternatively, for those of you that are struggling with connection issues, we are hoping that by pre-recording this, at least one of the factors in getting the information to you swiftly and without any side issues will at least be eliminated. Because we are pre-recording this, we obviously cannot at this point discuss anything that is going to be discussed during the emergency budget meeting that is planned for this 24th of June on Wednesday. So if there's anything flowing from that particular emergency budget meeting, then we will discuss it probably in our weekly that we would send out on Thursday, as well as then next week. If there's any additional information that we need to get out quickly as SAIT, we will obviously send that out as soon as possible via alert. During the session, because we are pre-recording it, we are also making available the people that will be presenting in the chat function, so that if you've got any questions, you can at least ask them during the chat function. So whilst we won't be answering the questions during the webinar, we can discuss it with you in chat. I'm now going to introduce Jean de Toit from Tax Consulting. He's going to take us through the first 30 minutes just to discuss the general outline. There's just a general discussion. Then we're focusing on COVID-19 tax relief update. Then we're looking at SARS operations and trends. Thereafter, SARS legal and policy. And thereafter, to the extent that there's time, we're looking at new case law and the legislative cycle, whether anything has changed. Thereafter, we've got two tax experts that will be joining us just to discuss the 2020 tax filing season for individuals, which I think a lot of you are very much interested in, and I myself I'm quite strongly looking forward to that. There's a lot of changes in that area. So without further ado, Jean, if you can take over on your side. Thank you.
Thanks, Beatrie. And good afternoon, everyone, and thanks for joining us for this month's segment. If we can get started with the COVID-19 tax relief update. The first item on the agenda is living annuities, but I should rather first note that it was mentioned that the third draft of the tax relief bills would have been released by the end of May or the beginning of June, but I have not seen those as yet, and I think that's why the Minister of Finance issued government notices with regard to living annuities, but we'll discuss that now, which was it was gazetted in 2 government notices. The notices on expanding the access to living and annuity funds were gazetted on Monday, 1 June 2020. These notices give effect to the legislative framework required to implement the tax measures in this regard. Therefore, as of now, access to living and annuities has been expanded for a limited period of 4 months, which was initially introduced, now beginning on 1 June 2020 and ending on 30 September 2020. I think they gazetted these notices because the tax relief bills have not yet been promulgated. It looks like that will only happen later in the year or towards the end of the year. Just for everyone's benefit, I'll just briefly recap what that means. It allows individuals who receive funds from a living annuity to immediately either increase up to a maximum of 20% from 17.5% or decrease down to a minimum of 0.5% from 2.5% the portion they receive as annuity income, instead of waiting up to 1 year until their next contract anniversary date. Further to this, it allows individuals to adjust their drawdown rates at any time during this period, irrespective of whether or not the contract's anniversary date falls within the said period. Once the 4-month period lapses, the the drawdown rates automatically revert to the rates previously applicable. Individuals whose anniversary date falls within the proposed 4-month period from June onwards, they may elect to amend their drawdown rate either in accordance with the existing provisions, which would make the election valid until the next anniversary date, or they can do it in accordance with the relief package, which applies for the limited period of 4 months, which would result in their drawdown rate automatically reverting to the rate elected at their previous anniversary date after the 4-month period. And as a final note, the 50,000 Rand, which is the minimum value of the annuity or part of the retirement interest which the individual can withdraw in the event that there was any previous lump sum commutation in the fund, and 75,000 in any other case, be replaced by a single threshold of 125,000 to be applied as the de minimis amount.
Just on that, John, the 125,000 Rand, when you look at it, the de minimis amount there it's basically the 1/3. So the 1/3 is 125,000 Rand. So if you look at it, when you look at living annuity specifically, you can't look at it in isolation. You need to look at what happened at the point in time when the person actually exited the fund, whether any lump sum was taken or not. And then based on that information, you can then determine whether or not you're looking at the 1/3 or the 3/3 when you see whether or not you can commute the living annuity. So if anybody would like to get more information on that, or you would like us to do a segment on that, or just provide you with more information, then please just drop me a note so that we can do that, because I know that specifically living annuities and life annuities and so forth, that's not generally from a tax practitioner's perspective. It's more your financial planners that deal with that a lot. So if you would like to get more information on that, please let us know.
Perfect. Thanks, Beatrie. I think then we can move on to the next point, which is the new tax legislation beyond the tax relief bills. As I mentioned now, I'm not sure when those will be promulgated. But in the same vein, normally the new tax bills for this year's legislative cycle should have been published round about now. But obviously, given that there would be an emergency budget and the previous budget seems to be less applicable than they initially intended, I'm not sure when those will be published either. I think, and I'm also not certain if there would be two separate pieces of legislation in light of the budget that was introduced in February, and a separate set in light of the emergency budget that is set for this week. I guess we'll have more information on that as the week unfolds. But that would be
that's actually quite interesting, John, because what we normally expect is that you have a piece of legislation right in the beginning of the year, round about the bill time, when you have a discussion of rates and thresholds, and that puts in place the things on kind of tax rates on PIT, etc., your lump sum tax tables, other information that needs to be implemented kind of as from 1st of March. So all of you that deal with payroll would know that the moment that budget hits, everybody in payroll works to get that information into a payroll as soon as possible. But then thereafter, there's normally a taxation amendment bill, draft bill that gets promulgated, and sometimes a revenue laws amendment bill that gets promulgated. This year, because of the difficulty around COVID, we had kind of a tax relief bills, both from a tax administration side, obviously, in terms of tax deferments, etc., as well as then a normal tax relief bill that were initially just draft bills, and then the first and second and then the third iteration that we're expecting. So I think where we're sitting at present is that whatever was cast forward in the budget 2020, when we listened to it in February, it was done without any consideration of what COVID might bring. So when Jean says it might be folded into one bill, I suppose from a legislative perspective, it would be easier for us all if things would be kept separate, but it's always a possibility that things could be put together because, of course, at this point, we have not yet seen a draft bill on the tax laws and revenue amendment bills, and we haven't seen a taxation laws amendment draft bills. So the question at this point, I suppose, for me is to see whether or not and which of the items that were discussed during Budget 2020 will be changed and to what extent that will be changed, whether or not any of those items, other than the rates and thresholds specifically, will be taken forward in this legislative cycle, because all the effort, I suppose, at this point from a legislative drafting perspective as well as tax administration perspective thus far have been centered around COVID itself. So on that point, the thing I think that for me is particularly interesting is that when we look at just the legislation not having been promulgated around COVID, is that I don't know which of you have seen the discussions around the Minister of Education calling for a deferment of SDL rather than an SDL holiday. And there's been some information in the press around that, an article written by Barbara Curson on this. But the primary kind of crux of the matter is that when you look at tax legislation that is drafted and the mandate lies with National Treasury, in this particular case, in the draft bill, the SDL holiday was granted, and to be fair, it was granted with a view to future promulgation but retrospective implementation. Now, we rarely, if ever, have something like that where legislation will be introduced and implemented only in the future. Sorry, not implemented, promulgated in the future, so it will become law in the future, but with retrospective application, unless, and this is a very important part, unless you have already communicated the information at some point and there is trust between the National Treasury and the people in that regard. So, for example, if we take the thresholds that are communicated every year, when National Treasury brings out in the budget and the Minister of Finance says, as from 1st of March, this is the rate and threshold for personal income taxes, we know that we can trust that, even though the bill and the legislation around that will only be published at a future date. Similarly, under that same trust principle, everybody has been working from SARS, which is an administrative institution which normally would not implement legislation which has not been promulgated, not even legislation, future prospective legislation. Nobody would work with it, nobody would implement it, nobody would put it into a system unless there is a trust relationship between the administrative entities, between the payrolls, between SARS, and then the people of the country, the taxpayers, the tax practitioners, and National Treasury. So on that premise, everything has been working around the COVID tax relief legislation, be it with a tax deferment, be it with the SDL. So at this point, from my perspective, what it looks like is everything is working on the premise that we are, as a country, in sync with National Treasury. The fact that there is now a question mark around SDL seems to me to be something that must be sorted between National Treasury and the Minister of Education, and should not, as a matter of course, affect how we have been doing things thus far. So at this point, I would still treat the SDL as a holiday in the same way that it has been discussed by National Treasury, as it has been proposed, as it has been implemented by SARS, and as it has been implemented by payrolls. So the only other matter, I think, on COVID tax relief that is critical to discuss is that we have seen in some instances that the treatment from SARS around the tax deferment, not that there's different treatment in how it is being applied, but the different channels there seems to be a bit of confusion around that, which we have discussed in our tax practice update weekly that we send out. in certain instances where people have been using the designated tax relief, COVID tax relief email addresses to request tax deferment in the case of their PAYE or for provisional tax or in any of the other instances, the intention initially, as we SAIT understood it, and I think as most of the country understood it, was that it would be a one-size-fits-all channel where you would apply for tax deferment and at the same point request for your penalties to be waived, because it's that package that was proposed in the tax relief legislation. So from that perspective, the intention we thought was you apply, you provide the necessary information, and at the same time your penalty gets remitted, and at the same time your tax gets deferred to the payment periods as discussed in the proposed legislation. However, in certain instances, it would seem that when such an application reaches SARS, it is recognized in respect of one of the two items, so either as a please remit my penalties, or alternatively, I would like to have my tax deferred in line with the legislation, and then SARS expects a different application in terms of the other items. So for example, you must still apply to get your penalties remitted, or you must still apply for your tax to be deferred. So if you are sitting in any of those instances, please drop us a note via the tax helpline so that we can collect some information through to give to SARS. Jean, I think the other item that we need to discuss is possibly expats under the COVID-19 tax relief.
Yeah, and I think this flows from exactly the same problem. Because obviously expats either got stuck or were marooned, if I can put it that way, in either South Africa or in their host country. And from a tax perspective, that can have very consequential impact on their tax liability. For example, as we noted in one of our earlier webinars, if you are a South African expat relying on the Section 10102 exemption, you must meet the day's tests to be out of South Africa for certain periods. And if you were unable to travel during this time, it's very likely that you may not meet those requirements, and you would not qualify for the exemption, and your tax liability under South African law would be much higher. And I know SAIT and other stakeholders have made submissions on this to National Treasury so that the day's requirements in terms of treaties and the Section 10102 exemption be disregarded for this period, purely because it's out of everyone's control, and it would be immensely difficult to distinguish this on a case-by-case basis. And because the legislation has not been promulgated, and because we don't have feedback on that as yet, it makes it very difficult for employers and employees to declare their taxes correctly as they go on, especially if you need to withhold tax at a certain rate. If one of your employees has been stuck in South Africa since, let's say, March, where they would normally be in their host country for the entire year, it raises the question whether you should be withholding pay as you earn or not. But again, we haven't had any feedback on that, so it will be interesting to see what happens when the bills get promulgated, and if expats would be given any relief with regard to either the day's tests or residency and source issues that may also arise. But if we get feedback on those submissions, we would definitely share them with everybody.
Actually, Jean, I quite hope that I know that people will be listening to this after the budget. We are actually trying to get this program pushed to maybe the day or a few after the budget, so that people can listen to both. But it would be interesting for me if that kind of item is discussed. I know that in certain other countries there has been kind of suggestions, especially from the OECD side, on what to do with permanent establishment, what to do with people stuck in a particular country. So it's hope from our side, at least, that National Treasury also would would provide some relief for people stuck in a particular country, so that you don't then trigger PE or trigger tax residency in a country, and then similarly that the relief that you would normally enjoy at least then continues to apply even though you are stuck in country.
Yeah, I think you touch on an important point. It extends far beyond just the individual. It's got corporate tax implications potentially as well. So it would definitely make sense for Treasury to have a bit of foresight there, instead of just trying to collect tax from South African expats stuck in South Africa. But I guess we'll have to wait for the budget. But I also hope that they clarify that item for us. Moving on to the next is SARS operation and trends. The first item on the agenda is filing season for 2020. The second segment of the show will be dealing with that, but Beatrie, you noted that you guys did a survey on this.
Thanks, John. It was a very telling survey. So by far the vast majority of our members feel that the date of 1 September is way too late, and there's a lot of concern that people will not be able to submit in time with all the people that they need to submit tax returns for. Another point to note there was that a lot of the members that we have, and a lot of tax practitioners, only about 25% of the taxpayers that they represent would lend itself to auto assessment. So we're sitting with about 75% of tax practitioners' clientele, if you were, or tax returns that they prepare on an annual basis that would not be suitable for auto assessment. So from that perspective, SARS is engaging, or SAIT is engaging with SARS on that, and we will keep you abreast of any and all discussions in that regard. But after this session, you will have a 30-minute session wherein we will discuss with our tax experts just exactly how can we meet this challenge, even if there's no changes from SARS side in terms of the phases that they have just decided on for this particular filing season. How can we as tax practitioners do everything from our side to make sure that we meet the challenge?
Yeah, and I think there's one more item that you wanted to discuss under SARS Ops, which is problems relating to the SARS contact center.
Thanks, John. Yes, we've been getting a lot of issues from our members with regards to the SARS contact center that has been giving problems in the sense that people would be holding on for kind of 15 minutes and then it would cut out, or people would ask for a call back and it would not happen. Alternatively, people would be holding on for an hour and a half and then be answered and again cut off within a minute or so. So if you've been having any problems with regards to that, it would help if you've got a date and time and so forth also available, so that we can give the details through to SARS. Please send us through via the helpline so that we can kind of make a list and give that through to SARS. If we have dates and times, it does help them to isolate where the issues lie. We know that the Mitchell's Plain call center, I don't know actually if it was centered in Mitchell's Plain, but the Cape Town call center has been closed. There's been a lot of movement from SARS to try to make sure that there's alternative arrangements. But please let us know if you've been experiencing problems in that regard. Thanks, John.
And just some interesting things that we've noted on our side that have actually been very helpful in light of the pandemic was usually where the taxpayer is required to visit the branch to verify the banking details registered with SARS. Due to COVID, SARS relooked at their service offerings, and taxpayers now do not need to visit the branch in order to verify banking details. SARS now provides a link on e-filing where all the required documents may be uploaded. In addition to this, SARS requires a taxpayer to upload an image of themselves holding an ID book and a note clearly showing that the case number and date when the documents are submitted. I don't know if everyone has dealt with that, but it's been very useful for us in getting things done. In the same vein, VAT registrations have been simplified immensely as well, and the whole process has been expedited. The SARS has suspended the need for VAT interviews as a pre-registration requirement, and taxpayers can now obtain a VAT registration certificate online. As you may know, previously the only way to obtain the certificate was by going to the branch. The same with SARS appointments. In order to avoid the long queues at branches, they introduced a new online booking system for taxpayers and tax practitioners who need to visit the branch for specific and exceptional reasons. The system now provides information regarding time slots available at a branch, and an immediate confirmation is sent to your email, whereas previously our tax practitioners would wait for a few days before receiving confirmation from SARS. So that is nice to see that from a SARS perspective in dealing with things immediately. Moving on, I'll run through these very quickly. SARS and legal and policy. There's a new SARS interpretation note 87 on headquarter companies, and there's a binding private ruling 344 on the transfer of listed financial instruments to collective investment schemes in exchange for participatory interests. I'm not going to discuss those. If you have any questions on them, you can drop me an email and I'll send you some notes on that. Then there were two cases that I will run through very quickly because I see we are running out of time. I'll discuss the Barnard Labuschagne Inc. versus SARS first, as this also dealt with one of SARS's collection mechanisms where they get judgment against you by filing a statement with the court, which means that if they do that, they effectively get civil judgment against your name, and they can use that. It's got the same effect as a civil judgment, which means they can execute against that. They can attach your assets in satisfaction of the tax debt. In this case, the taxpayer tried to rescind this judgment, and the court found that it's not an ordinary judgment in the normal sense, as it does not decide a dispute. So you can't actually rescind or use the normal rescission procedures to do this. The only way that you can actually challenge this is under the Paja Act, because on the basis that it's been an unfair administrative action. But the important takeaway from this case is that SARS will likely in the coming months collect more aggressively. So if SARS, once they start collecting, it's very important to be vigilant and to ensure that they followed the proper procedures. This also flows from the discussion we had last month on the SIP case, where SARS used a third-party notice. It's very important to check if there are any final demands on e-filing, and if SARS are invoking their collection mechanisms, it's very important to also check that they followed the proper procedures and that their notices complied with the Tax Administration Act. Because we have definitely seen from our side where they skip certain steps, or that their notices do not comply, and all of a sudden the taxpayer's bank account has been emptied without them knowing it. The second case...
John, I think,
yeah.
Just before you step on, I think one of the most important things as a tax practitioner is that you facilitate the relationship between the taxpayer and SARS. And to the extent that the taxpayer isn't aware of the legislation protecting them from unfair administrative action, or how to challenge something, a decision or action from SARS, it is our responsibility as tax practitioners to step into that breach and to protect the taxpayer. So from that perspective, I think one of the most important things is during this time where we know that our taxpayers have got an issue with regards to cash flow, we know that in some instances they are battling to make ends meet. If you need to, from your side, make payment arrangements with SARS, make sure that you follow due procedure. If from SARS' side they are not following due procedure and they're not doing what they're supposed to be doing, make sure from your side that you protect your clients, that you know exactly what to do under which circumstances. So when it comes to the Tax Administration Act, that you know when to object, where to go when, for example, in this particular case, like Jean says, the only recourse that you would have would be PAJA. So in that instance, it's not something that I think we can be unaware of as tax practitioners. It should be one of the things that's very close to us in our arsenal. We can't just be like previously where we say I'm a kind of a VAT guy and I know a lot about VAT and primarily I focus on VAT, but then when it comes to tax administration, that's somebody else's issue. So from this perspective, whatever tax you are involved in, you need to have at least the first kind of basics around the Tax Administration Act, so that when it comes to items like these, that we can protect our taxpayers and we can protect our clients. Because like Jean says, we are expecting not only more aggressive collection tactics, but also to the extent that SARS, like any other institution at present in country, cannot be fully staffed. We cannot expect things always to go 100% correctly. And that's not through lack of trying. I think always, sometimes it's just an error. And then you need to know what to do from your side. So again, if there's anything that we can do from SAIT side to help you in this regard, please let us know. Thanks, Jean.
Thanks, Beatrie. Yeah, I think it is very important to know exactly what to do when those processes start, or when SARS initiates those procedures, because once those notices or these judgments are in place, it's very difficult especially for individual taxpayers, to get back from that. And it's sometimes, or most of the time, it's just not feasible for them to approach the High Court to get these decisions reversed. So it's very important to be vigilant and to either dispute the tax or file a suspension of payment, whatever the case may be, but to deal with those final letters of demand as quickly as you can. The second case, I will have to run through this one very quickly, but this deals with the interpretation of double tax treaties. What it effectively says is that where there's a term that is ambiguous or is not defined in the double tax treaty, what the court needs to do is it looks at what that term means under the domestic tax law of the country using the treaty at that time. In this case, it was they looked at the meaning of the word employment versus an independent contractor under UK domestic tax legislation. And ultimately what that meant for the taxpayer was he was taxed under Article 14 of the DTA rather than Article 7, because under UK legislation he was deemed to be an employee and not an independent contractor, in which case he would have been taxed under Article 7. And in that case, his income would not have been taxable in the UK. But because it was interpreted from a UK side, they used UK domestic legislation to find that he was an employee, which meant that the UK and South Africa had a concurrent taxing right. So it's just important to note that, especially where treaties use international tax language, how to go about interpreting those terms. And I think that brings us to conclusion. There's also a discussion paper on excessive debt financing and interest deductions and other financial payments, which was introduced in the February budget, but this has also been postponed due to the pandemic, and I think we will potentially hear more about that when the emergency budget is introduced. So from our side, I think that's it for this week, unless we deal with the emergency budget in live terms, but we'll get to that later in the week. Beatrie, I don't know if you have any other closing comments.
Thanks a lot, John. I think what we will try to do is, once this is broadcast, to the extent that it's possible, we will also just tag on a quick discussion on what happened during the emergency budget, depending on exactly when we get this broadcast. So catch you on the other side when we discuss the 2020 tax filing season for personal income tax. Thank you and goodbye.
Perfect. Thank you. Thanks, everybody.
Good afternoon, all. This is Beatrie Gouws speaking from SAIT. Thank you all for joining us for this June 2020 session of Tax Practice on the Move. And we're dealing with a rather controversial topic for this last half an hour of the webinar, and that's particularly filing season 2020 for individual taxpayers. Now, some of you have already read our weekly tax practice update that we sent out kind of a couple of weeks ago, where we discussed SARS's new approach to filing season and where it originated and what we can expect. But I think in order to position our discussion from our two tax experts from BDO, we've got Doné, Howell and Nicoline, Benzien on board to discuss this for you. I would just like to position kind of SARS's approach for you so that we can discuss how we're going to deal with this. But before I launch into that part, we have done as SAIT a survey to see how our members feel about this, because we started getting quite concerned mails from you letting us know that you're concerned about the fact that not only does filing season start later this year, but also that it ends earlier for non-provisional taxpayers. And the concern is mainly that as a result of the shortened time length of submission time, that most tax practitioners don't feel that they will be able to actually meet the requirement in order to get all the tax return in time. So what we did is, in our survey, we tried to see kind of what can we do from our side to get data to motivate any kind of submission to SARS that we do from SAIT's side. And what we found is that around of the kind of population that we've got of our members, of the tax returns that our members prepare, on average, only 26% of those returns can realistically be auto-assessed. Now, I know some of you are not yet au fait with what auto-assessed means and how that would work, and Doné and Nicoline will take you through that. But what that means for us is that predominantly kind of 74% of tax returns would only be eligible to be completed and submitted as from 1st of September. And that is quite concerning if we look at the fact that we still have some system glitches to deal with that have not yet been resolved. We send that out on a weekly basis as well, so you are probably aware of all of those. And then, like we saw with filing season last year, and where pre-filing season, where we had the whole new e-filing launch and how that affected everybody, there's always a set of communication issues and glitches that need to be dealt with that also then impact tax practitioners. So in order to deal with all of that, we are going to discuss the findings of our survey with SARS. So the first point was the fact that about kind of 74% of our returns cannot be auto-assessed. And then the second point, which I think is critical, is that of our membership base, either they don't like it at all, so they're very much against the 1st September launch date, or very much against the 1st September launch date. Is around 73% of our membership do not approve of the 1 September 2020 submission date. And that is quite concerning in the sense that it gives us the data behind it that most of our members would prefer the submission date to start a lot earlier. And in fact, around 60% of you said that you are quite happy for the submission date to start 1 July, that you would already be in a position to start submitting returns from 1 July onwards. So From that perspective, we will use this information to populate our submission to SARS, just to explain what our concerns are, and to ask them to just reconsider and to see if there's not a way in which they can accommodate tax practitioners in assisting them. So on the basis that our submission doesn't bear fruit, because we have to work on the premise that, yes, we do submit, but what can we do from our side to, in the event that there is no change on SARS side, what can we do from our side to make sure that this legislation, or not this legislation, that this filing season goes well? Part of that is to understand why SARS has made the decisions that they have made with regards to the 3 phases. So for that, I need to take you back a little bit to the time where SARS launched EasyFile 20. It was, I think it was on 16 October 2008, where they started the reporting of third-party data, mostly from an employer perspective as well as a pseudo-employer perspective. So that would be the guys who pay out annuities and who pay out lump sums, because they're also designated employers from their income tax perspective. And the reason why SARS did that is they started, in as much as most revenue services across the world are starting to create channels where they can get structured and verified data from third parties, so that by the time that they look at the data supplied by taxpayers, they already have a pretty good idea of what to expect from the taxpayer. And because they get structured data and verified data from the third party, they eliminate or mitigate a lot of the risk in accepting information from taxpayers. And in doing so, they not only get to a point where they can kind of preempt what to expect from taxpayers, in the sense that they can pre-populate returns, but they can also, to a great extent, do risk assessments, they can do risk analysis, because you can only do risk analysis when you have properly structured data. And by doing so, their focus can shift from focusing on largely tax-compliant taxpayers to non-compliant taxpayers, which is one of the things that we as tax practitioners and SAIT, certainly on our side, have always wanted SARS to focus on. We want them to focus on the non-compliant rather than kind of keep on hitting up the compliant taxpayers. So if you go on the premise that all over the world, revenue services are strengthening the way that they get data and they accept data from third parties, they're strengthening those channels on an annual basis, then in this year, for example, where you're now going to have IT3Bs, your interest received reporting done through from the banks, etc., through to SARS, where you're also going to have that pre-populated. The intention is then for all of that information to be pre-populated so that you eventually, as a taxpayer, as a tax practitioner, have not only something to work towards from your perspective, so it matches up against something on the revenue side on their system side, but also that there's another element to it. The second element is that you don't get a lot of objections or corrections after the fact. That is the intention, because it must be something where SARS already has a plan and they've got information on their side, and whatever you provide should match. And it's only to the extent that it does not match where you then should sit with a dispute resolution process, where there's corrections and objections, etc. Ideally, and I think that's the thing that we're working with, is we know we're not in an ideal world yet, and we are working towards that, but the ideal is that you sit with a situation where your third-party data creates basically a profile already of what a tax return should look like. And as a taxpayer and as a tax practitioner, you have information on your side that should match that. And I think when Doné and Nicoline now takes you through what they see from their side, that is the picture that I need you to keep in mind, is that we are not going to move away as a country and as kind of a global revenue services We are not going to move away from third-party data and pre-population and all of that. That is something that is here to stay, because it is just from a risk perspective and from a kind of where do you put all your effort in. It does not make sense anymore to keep the tax return as the trigger for everything. The trigger is now earlier, where you get the data from third parties. And that is predominantly where I think our tax practitioners' focuses should shift from where it used to be only on the tax return and predominantly focus there, to much, much earlier, to where your taxpayer and where your client starts getting information from third parties on their side to see whether that actually matches what they expect. So on that note, I know I've given you a mouthful. I'm going to hand you over to Doné Howell and Nicoline Benzien from BDO to take you through the 3 phases of filing season 2020. And we're going to do a practical breakdown, and then also kind of how do we adapt? How do we address fees, marketing, what new procedures should we look at, and then also the positioning from a taxpayer's point of view. Please note that you can also ask questions in the chat function during the session. We are pre-recording this, as you know, just to take one of the variables out of listening to this recording after the fact. So I hope you enjoy.
Thank you, Beatrie. Clearly the intention with the 2020 filing season and future filing season is to shift the focus and effort of SARS officials to pre-filing verification, as opposed to post-filing assessment verification. However, what we would like to stress is that the tax return, irrespective of whether it's pre-populated by SARS using trusted data or information, remains a solemn declaration made by a taxpayer that the tax return in its entirety is full and complete. Now, the taxpayer cannot make such declaration without satisfying him or herself of the accuracy of the data, and therefore, irrespective the change in focus, a lot of work still needs to be done in order to vet third-party data, to check for reasonableness, to cast and match, and to compare to prior tax years, to ensure essentially that such information is disclosed on the tax return in order to reflect the true position of the taxpayer. The new 3-phased approach that SARS has introduced essentially allows for, and phase 1, which has come to an end at the end of May, was for the submission to SARS of the employer annual reconciliation, as well as third-party data for verification purposes. Phase 2, which is currently running until the end of August, will allow for the check-in of taxpayer personal details, as well as the check-in by us and taxpayers of the third-party data. And finally, the 3rd phase will be the submission of the tax returns. This will run from September all the way to the end of January 2021, but we'll talk to the specific deadlines for each category of taxpayer. This 3-phased approach compared to the prior year's 2 phases. Now, you'll recall that prior years were largely employer filing season and then the employee filing season, which ran then from 1st of July to 31 January of the next year. Phases 1 and 3 have largely remained the same, but phase 2, now specifically set aside by SARS, in order for tax practitioners and taxpayers alike to verify the taxpayer personal details and to review third-party data. The reality is that tax practitioners have always attended to the 2nd phase as part of our internal processes of updating taxpayer personal details, of vetting, casting, matching of third-party data to the pre-populated tax returns, as well as comparing this to prior year information. We believe the fact that SARS has now separated the function and assigned a time period to this does not necessarily equate to additional work for us, but rather it highlights to taxpayers the fact that such work is a separate function in the larger filing process and requires the taxpayer's time and effort. Taxpayers should realize that full and complete disclosure, as well as the updating of personal details, is a statutory requirement. Falling foul of this could ultimately lead to criminal sanction for taxpayers. As Nicoline will elaborate, BDO has always assigned a value to such administrative function, and therefore we feel justified and have always felt justified in charging our clients for such work. Now is the opportunity to educate your clients of this statutory requirement, the work and time involved, and then to re-engage fees within this new environment.
Yes, thank you, Doné. We at BDO has for many years regarded the three-phased approach as best practice and has been implementing this methodology as part of our pre-filing model. We are therefore fully supportive of SARS now setting specific deadlines to these phases, maybe not to the limited time allocated to the respective phases, but specifically the start of the actual filing season being pushed forward to September only. Now, in our experience, it's highly recommended that practitioners approach this filing season with a lot of structure. The first step being to engage with your client, informing them of the new phased approach adopted by SARS and what the practicality is of these and what it all necessitate, and basically just keeping your client engaged. From a practical point, what we've done as a first step in the verification of personal information and to assist our clients with the phase 2 verification process, we have provided them what we call a client card, and this was generated by our in-house tax software system consisting of specific biographical information that speaks to the information required by the SARS RAVA 1. This card is then shared via email and facilitates an electronic update of any information by our clients. But that's not where it stops. Then there's a second step in the verification of your current 2020 tax data. A request is sent to our clients for all their 2020 tax data, and that gets vetted against the prior year's tax data for completeness. Any discrepancies are then reflected as a non-reconciling item. The 2020 current year's tax data is further verified against the pre-populated data as obtained by SARS from third parties. And all of the non-reconciling items is highlighted. You are basically preparing a preempted tax data recon. Now the question, does my data recon match up, yes or no? If the answer is yes, that's great. You are good to go and ready for filing your tax return as from 1 September. However, if my recon of data does not tie up, now this is the tricky part. I need to further engage with my client by entering into discussions, highlighting the mismatches with them, and provide them with further guidance as to how to best approach, for example, the employer in getting a revised IRP5 issued, or approaching your investment companies to provide you with a revised IT3B certificate. And this could be a very drawn-out and time-consuming process. But it is a very important phase that will ensure seamless filing of the actual tax return based on verified and correct data. A significant amount, as you reiterated, Doné, goes into the pre-filing process before the actual filing of the return is done. And this brings me to the point where the credibility of practitioners who follows an upfront billing approach to be most justifiable. We at BDO, what we call an admin or composite fee, are raised during May of every year to cover the various admin responsibilities, including the cost of expending on the pre-filing verification process. A second bill is then issued on completion and submission of the actual tax return. This could be an option to be considered by the smaller practices, and this will assist them with the imminent cash flow issues they will be facing due to the delay in the filing season, and further basically pushing out their normal billing cycle. The two-fold billing approach will further assist your client with the down payment of their tax fees.
Great, thanks, Nicoline. So, further to the phase 2, SARS will also issue the auto assessments. as Beatrie had alluded to. A taxpayer can either accept this auto-assessment, which is based on the third-party data, and thereby finalize their filing obligations. Where taxpayers do not accept the outcome of an auto-assessment, taxpayer would have to file their return during phase 3. And finally, what phase 2 allows is for the Government Gazette to be issued. The Government Gazette, as you will all recall, confirms which taxpayers are required and which are not required to file a tax return. In this regard, we're quite curious of the interplay, if any, of this auto-assessment process with the simulated outcome assessment process. You will recall the introduction of the simulated assessment during I think it was the 2018 filing season, as an initiative from SARS to streamline the filing process, where simulated outcome assessment was issued to taxpayers who met the requirements for being exempt from the filing obligation. 2019's tax season had the requirement that people with total employment income which doesn't exceed 500,000, as an example, did not need to file, or employment income was received from only one employer. No other form of income was received, as an example, your business income, rental income, taxable interest, and no additional allowable taxable deductions or rebates were to be claimed, like your medical expenses and RAs, etc. So what the interest or the interesting thing is to the interplay is that it could be a very busy phase 2 period for tax practitioners in order to track and consider the auto assessments where taxpayers are required to render a tax return, and as well as where SARS are issuing these simulated outcome assessments where taxpayers are not required to render a tax return. Phase 3, although SARS makes reference to phase 3 as an employee filing phase, the filing obligation actually applies to all taxpayers. It commences on 1st of September and follows the following timelines. By the end of, the 22nd of October, allows for manual returns to be submitted to a SARS branch, but remember, by appointment only. The 16th of November would be the e-filing submission due date for non-provisional taxpayers. Now, remember, compared to the 2019 filing season, this is about 3 weeks shorter than the first week in December that we had in order to file non-provisional taxpayers' returns for 2019. And then we've got until the end of January 2021 for the e-filing submission for provisional taxpayers.
Thank you, Doné. Yeah, and based on all of this, as much as this phased approach adopted by SARS makes perfect sense, what it also does is taking away a big chunk of the filing time afforded to practitioners that still need to push out the August and September provisional calculations and submission of the IFRS 6 returns. And we understand that SARS has sophisticated risks engines in place to detect discrepancies from information they receive by employers and third-party data. However, we need to focus on certain high-risk taxpayers, including those foreign workers in South Africa, South Africans working abroad, having large capital gains, rental income, or distributions from trust that are not pre-populated per the auto-assess process, to be careful in not willy-nilly accepting those SARS auto-assessment, as these additional income streams, as I said, is not pre-populated, and this could expose them to possible penalties and interest, and not mentioning the additional cost layout to our clients for lodgement of objections or appeals to SARS. And further, it's just delaying the issue of a correct assessment and a possible refunds to our clients. It is further also highlighted in, for example, our SARS technical alerts of the challenges faced by couples married in community of property, particularly when it comes to proper reporting of their tax-free investments. And we strongly advise these particular high-risk taxpayers to engage with an experienced tax practitioner to assist them with the filing of their returns.
So I think in summary, the challenge that we as tax practitioners face is how will we ensure quality and accuracy in respect of the disclosure of tax information within such a tighter deadline period. We therefore look forward to hearing SARS's feedback to SAIT submission to extend the filing season deadline. Thank you.
Hi guys, so we've got quite strong views, I think, from most people with regards to where we should go to with filing season 2020. And I suppose the challenge for us as tax practitioners at this point is that even though we might get a little bit of a relief this year in terms of extended timelines and so forth, we are ever hopeful. The point is that going forward, we are going to enter into a world where it becomes more and more likely that the majority of your work might be pre-tax return, where you are casting forward to submitting the tax return, where you need to know what the taxpayer's third-party data should look like so that you can engage thoroughly with the third party. And in that sense, just from my own experience with providing third-party data to SARS, the third parties often work with massive systems. So you have banks, you have fund administrators and so forth. And we all know that when it comes to accepting data from either the third party or the taxpayer, SARS is not going to budge on the taxpayer's kind of how can I put this? Because now I'm thinking in Afrikaans again. The taxpayer's version of events. You cannot rely on the taxpayer's version of events if your basis that you are working on as the revenue service is the third-party data. So in all of those instances, what would have to happen is the third party would have to resubmit. Now, those of you that have gotten a bank to resubmit their IT3Bs or the RP5s from a fund administrator, be that Old Mutual or Sanlam, or your Metropolitans, Momentums and Liberties, Alexander Forbes, it takes quite some time. And yet that is what would be required from us as tax practitioners going forward, is we would need to start strongly engaging to make sure that the data that is provided to the revenue service that pertains to our particular client is done correctly. Because if it is not, then irrespective of what we provide on our side, it would not be sufficient. So for me, going forward, that relationship between tax practitioners and third parties that provide data on my taxpayer, on my client, becomes a very critical focus point going forward. I hope to have good news for you a month from now, but for now, I think we are going to try to push forward this particular tax webinar so that we can at least all listen to the budget, the emergency budget being read. And to that extent, if there's anything that we need to discuss on the emergency budget, I think it should follow after this. Thank you very much, and I hope you have a good day. Take care. Goodbye.